Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karamali, live from Yahoo Finance's studios in London. It's Tuesday, 12th August. Coming up on the show, Asia's stock markets rise after Trump extends the China trade truce for another 90 days. Wall Street braces itself for July's inflation report. We'll tell you how the numbers could impact what the Fed does next. And semiconductor stocks are in focus after China urges firms not to use Nvidia chips and Trump has an interesting meeting with the Intel boss. So grab your coffee and let's own the morning. For our first thing to know about before the opening bell rings is the market reaction, especially in Asia, to the news that President Trump signed an executive order last night to extend the tariff truce between the US and China by another 90 days. Well, as you can see, Asian stocks rose, with Japanese equities hitting a record high. China's blue chip stocks, the Shanghai Composite, also traded higher on the news that the headline rates agreed back in May of 30% on Chinese imports and 10% on American goods will continue for the immediate future. Asian chip makers were among the biggest gainers. The likes of Japan's Advantest and China's Semiconductor Manufacturing International traded significantly higher. The new pause could also increase the odds for a meeting between Presidents Trump and Xi. On Wall Street, it's also looking like the markets will open on the front foot too. Oh, they're actually now just ticked a bit lower, but they were trading higher. We'll keep an eye on that for you. But there was some bad news for one big chip stock, Nvidia. China has urged local companies to avoid using Nvidia's H20 processors, particularly for government-related purposes. This is likely to complicate the chipmakers' attempts to recoup billions in lost China revenue, as well as the Trump administration's unprecedented push to turn those sales into US government windfall. Just yesterday, we told you about the president's plans to get Nvidia and AMD to hand over 15% of their China chip sale revenue to the US government. But another chip maker, Intel, is seeing some big positive moves in the pre-market. And again, this has some involvement from President Trump. He met yesterday with the boss of Intel, Lip-Bu Tan. The president on Truth Social labelled the meeting interesting and went on to say, quote, his success and rise is an amazing story. Now, just last week, the president had called on Tan to resign, and a Trump ally, Tom Cotton, had written to Intel over concerns about Tan's ties with China. And finally, gold or Bitcoin? A growing number of investors feel that they're having to make a call between the two, and we're seeing big moves in these markets. Trump reassured gold buyers yesterday by saying tariffs would not be placed on imported gold bars, but that didn't stop prices sinking. However, yesterday we saw Bitcoin rally sharply, trading close to its record high. It's trading lower today though. In the past, gold has often been seen as the safe haven of choice, while Bitcoin is an asset that many see as having high growth potential, albeit with increased risk. So, is gold still the safe haven of choice? Well, my colleague Brooke De Palma took a closer look with commodity analyst Carly Garner from DeCarly Trading.
Around half of investors have exposure to gold, with 4.1% as the average allocation, according to Bank of America's August Global Fund Manager Survey. Gold tends to creep into headlines when there's more economic uncertainty, prompting investors to seek safety in safe haven assets. Our next guest sees an upside scenario, but isn't necessarily bullish long term. Here with more is Carly Gardner, DeCarly Trading commodity broker and analyst. So Carly, let's dig into your outlook on gold. Where do you see prices heading by the end of the year? And do you expect any choppiness before we get there?
So I actually have an unpopular opinion. I think the gold rally is in its last leg, or you could say the ninth inning of the move. We've had an incredible rally in the last 3 years. Started around 1,600 in gold, and obviously now we're trading into the $3,500 range. But 3 years ago, if you would have mentioned gold to people, they would have thought of the exact opposite of what they're thinking of now. It was the dog of a portfolio. It hadn't done anything in over a decade. It doesn't pay interest or dividends, so there was no reason to hold it then, or so people thought. That was the consensus thought. And now we're in the opposite boat where everybody wants to own gold. Just as those people were probably wrong, well, they were wrong 3 years ago, I think they're probably wrong now. I think gold is the type of market that you want to be bullish when nobody else is bullish. When everybody is bullish is probably not the best time to be a buyer, unless you're just strictly seeking diversification and your time horizon is decades, not months or years.
OK, today we're going to focus on the inflation data out later today. It's the key number that all investors will be watching for, and it's coming out before the markets open today. If inflation is hotter than expected, then calls for interest rate cuts next month may become quieter. But a weak number will see even more pressure for the Fed to cut rates and do so quickly. July's Consumer Prices Index is expected to show prices rose at a faster clip annually compared to June. The expectation is for a 2.8% reading, up from June's 2.7% number. On a monthly basis, we're expecting an increase of 0.2%. That's slightly down from June's 0.3% reading. That's likely been driven by lower gas prices and expectations of moderately softer food inflation. In June, we did start to see tariff-driven cost pressures emerge, and so that is likely again to be in focus. Now, this all comes after President Trump picked E.J. Antoni to head up the Bureau of Labor Statistics after firing the former commissioner after that very gloomy jobs report, which he claimed was rigged. Now, these will be the first significant data release from the BLS under Antoni. Now, he's part of the Heritage Foundation, a Washington-based right-wing think tank which has often attacked the BLS. Markets are looking closely at this data, as you can imagine, and analysts at Morgan Stanley have said that if the number comes in weaker than expected, it thinks investors will begin to look more closely at smaller firms when it comes to investments. And of course, this data number, even though it isn't the Fed's favourite measure, is likely to have some bearing on what they do next in September. Well, Jon Hilsenrath, StoneX's senior advisor, gave my colleague Julie Hyman his take on how this data could impact the Fed's next rate call.
You have a couple of loyalists to the president already there. Waller potentially angling for the job himself. But you have regional bank presidents who have their own agenda. You have a couple of other Fed governors who are holdovers from the Biden administration. So there's no consensus right now that the Fed should be cutting interest rates aggressively. I mean, I think because of that weak jobs report, you're seeing more of the president saying, all right, maybe we need to take out a little bit of insurance, cut rates in September, and then see where we stand. But I think that we've exited a period of Fed consensus for really since the financial crisis of 2008. There's been a lot of agreement at the Fed about the direction of policy. And I think we're in a new period of Fed discord. And mirroring the two governors who are dissenting are kind of the leading edge of that kind of discord. And we're just going to see more of that in the months ahead.
John, you talked about Waller and Bowman, Waller in particular sort of angling for the top job, but he did, when he has laid out his reasoning for a cut, he's not just pulling things out of thin air. He has really leaned into the idea that the labor market is worse than it looks, and that right. Outweighs the inflation numbers and could eventually have a different effect on the inflation numbers. So, I mean, what do you make of that argument and how persuasive it is?
I agree with you. I mean, I think Chris Waller has made a rigorous and coherent argument for why he would be cutting interest rates right now. And I think that the fact that he's done that and the fact that he's made good arguments in the past about where Fed policy should be are reasons why the market would be very comfortable with him if he were to get the job.
Coming up, we'll take a look at Ford and the wider automotive industry being affected by tariffs. That's after this break. Welcome back. Now, if there's one industry that's going through major threats from tariffs and global trade shifts, that's automotive. And Ford Motors has been facing big challenges from the rise of EV makers, such as Tesla and China's BYD. Now, the American car maker just announced that it will be launching a new line of EVs, starting at an affordable price of $30,000. The CEO, Jim Farley, was on Yahoo Finance yesterday. He explained how this, quote, major change is going to play out for the company.
So, Jim, talk to me about this new Ford EV universal platform. Like, you're going to make this new midsize pickup on that platform. How is it going to sort of change things for Ford? A kind of a big departure for the company.
It's a huge change for us. We're going to change the way we build vehicles, maybe the way the industry builds vehicles. We're going to build the vehicle in 3 separate pieces and join them at the end of the process. That allows our workers to get inside the vehicle and to kit the parts, not on the side of the assembly line, but in the vehicle. The whole vehicle has been engineered for radical simplification as well. We have 20, 30% less parts depending on the vehicle. It's just a totally different approach for simplicity. And we have a new battery chemistry, LFP, that we'll make in Michigan. It's a $5 billion bet on U.S. manufacturing. We think this is a way to beat and beat BYD.
So Jim, that first vehicle will be a mid-sized pickup, I believe, with more space than a RAV4 apparently. Why do you think that's the best sort of footprint for that car now? And I understand that more cars will be coming after.
Yeah, we'll have different body styles. We want to start with the most universal car. This is what we think Henry Ford would have loved. Because a RAV4, let's say the best-selling passenger car in the U.S., great car, it's a hybrid. We have the Escape hybrid. This has more room inside, but then you have lockable storage with the front, and then you don't need to carry your bikes and all your work equipment on the roof, or with the tow hitch mounted system, you can all put it in the bed of your truck. This is a more universal vehicle. And we have a lot of other innovations we haven't shown people yet, where this mid-size truck will really not be a truck anymore. It's more like the ultimate next generation crossover.
So Jim, is this sort of the way that Ford and other, even Western automakers, can take on the Chinese, even Tesla, with sort of the smaller footprint, simpler manufacturing process?
Yes, this is it. This is a way to go. Look, we can go like others do and make their affordable EV in South Korea and Japan and import, but that's not what we're doing at Ford. We challenged ourselves 3 years ago with the Skunk Works team to approach everything differently. Radical simplification, new battery chemistry. The battery's actually the vehicle structure itself. It's not put in the vehicle, it is a vehicle. We build the seats on the battery, build the front and the rear separately, and combine it. This radically reduces our cost, including a 30% cheaper battery chemistry, and the battery usage is much lower than a BYD, like 20% more efficient. And we think this is the way we can make money on EVs. We've learned a lot. We've been number 2 to Tesla for a couple of years. We've been doing our homework for this next investment cycle, and this is the way for us to be competitive.
Do you think the loss of the EV tax credit is something that might play into this and make it easier to sell cheaper EVs in general?
Yes, absolutely. We've learned so much, but that $7,500 is going to go away in September. It's going to have a big impact on the market. And we didn't know that when we started designing this vehicle. We wanted to just make a profitable vehicle at entry. But what we started to learn is, look, people want to commute. That really, the duty cycle that matches an EV on the retail side, not commercial side, is definitely short-term trips. Someone who charges at home, they go no more than 300 miles on a charge, and they don't want to go to the gas station. And for them, this vehicle will be cheaper to operate than a RAV4 hybrid or even a 3-year-old Model Y, and there's a lot of those on sale. This will be a lot cheaper for those customers. Not for everyone. We have Super Duties and Broncos and Mustangs, but for that subset of people, this is a much cheaper. They can spend that money on vacations and a lot of other things.
Policy sort of weighs in here, but you mentioned with the EV tax rate, but also we're talking tariffs, and that's sort of affecting the affordability question. What's your sort of big high-level picture on what's happening here with, preliminary trade deals with Japan and South Korea, but still higher tariffs on Canada and Mexico, where we build a lot of trucks and using U.S. parts? What's your take on that?
Well, I think I'm optimistic that we'll find a way to work through the issues in Canada and Mexico. We're disappointed. We want a level playing field. 15% tariff in South Korea and Japan, not a level playing field. That's still a $5,000 advantage to import. But we're not gonna focus on that. We have a great relationship with the Trump administration. They're totally aligned with us as the biggest car company in the U.S. They want us to make these billion-dollar investments like Louisville today. And we are going to find a way, working with Howard Lutnick, the Commerce Secretary, the President, his whole administration, we are going to find a way to minimize those parts tariffs on America's biggest car company. We cannot be disadvantaged by betting on America, and we have confidence in the President that we'll work this through.
And we'll certainly keep covering Ford's next steps in this space. Stay with us. After a short break, we'll be diving into trending tickers today. Welcome back. Well, let's dive straight into our trending tickers. Okay, first up, Tilray Brands is in focus. Let's take a look at the stock price. It's up in the pre-market, up about just under 10% there after a 41% jump yesterday. A broader cannabis stock rally has been sparked by fresh hopes for US federal reform. Cannabis is fully legal in 24 states, but not at a federal level. Now, President Trump might change that. He said he's considering reclassifying marijuana within the next few weeks, potentially removing it from Schedule I, the category where it currently sits alongside heroin and LSD. That move could unlock tax deductions and open the door to new institutional investment. The legal cannabis market in the US alone is already worth more than $30 billion a year, and analysts see that number doubling within the next decade if federal barriers fall. Tilray's not alone. Canopy Growth, Aurora Cannabis, SNDL and Cronus Group have all climbed in double digits. Okay, our second trending ticker today is Tesla. It's trading at about $341 in the pre-market after it climbed nearly 3% yesterday. Investors are digesting some significant updates from the Musk empire. Yesterday, Elon Musk confirmed he's disbanded the Dojo supercomputer team and will pivot to in-house A15 and A16 chips. These chips are expected to power full self-driving Optimus robots and upcoming models like the Cybercab and the next-gen Roadster. Second, and this is very much a moving story today, Musk said his startup xAI was going to take legal action against Apple, accusing the iPhone maker of antitrust violations in managing App Store rankings, although he didn't provide evidence to support his claim. So, between AI strategy pivots and legal drama, keep an eye on the Tesla ticker today. And finally, we look at CoreWeave. The AI infrastructure firm is losing some steam in the pre-market ahead of its highly anticipated earnings report after the closing bell today. You can see it's down nearly around 3% after a very strong performance yesterday. It closed up nearly 8%. We're starting to see increasingly contrasting views on the stock. Bulls, including JP Morgan, remain confident that the growth narrative will hold, with high expectations fueled by increased infrastructure spending by major players like Google and Microsoft. But CoreWeave is a risky trade right now. The stock has seen wild swings and sheds roughly a third of its value from its June peak, burdened by rising debt and concerns that the recent AI hype may have peaked. Some market watchers point out that CoreWeave may not be able to deliver on the growth prospects it sold, and the stock might see more big swings in the coming days as the lockup prohibiting insiders from selling shares after the IPO expires in just 2 days' time on August 14th. Now, a lot of these big market moves we are seeing are driven by retail investors who are showing a big appetite for risk, but many advisors are still cautious. Shana Sissel, CEO of Banrian Capital Management, and Tom Sosnoff, founder and CEO of Tasty Life, explain why.
So the read I get from our clients, like you said, which are the advisors, the wealth managers that work with the retail investors, is obviously there's a lot of demand for these alternative investments. There's a lot of demand for risk, risk assets, crypto and the like, especially of the younger generations. I think the vibe from that audience, though, that we serve is a little bit of tentativeness. They are really concerned about risk, and we can circle that back to the 401k discussion. I think ultimately the issue here with plan sponsors is going to be the risk aspect of it. And so we spend a lot of time doing a lot of education, because while the demand's there, we haven't seen the flows. And the reason we haven't seen the flows is largely because the product is, kind of fragmented, and where it fits and finding it can be hard. Our industry does no service to that investor by poorly categorizing these things. But really, it's about understanding the risks associated, and nobody wants to, with the regulatory pressures and all kinds of guidance from the Department of Labor and the like, putting pressure on fees. You really need to be able to justify your fees, and advisors want to make sure that they keep the clients. And that's their number one concern. So for us, the vibe is, okay, I'm open to this idea, but help me get my arms around the risk so that I don't lose my client.
Yeah, makes sense. And then, Tom, same question to you for the audience that you guys are serving, who are people who are more directly involved in the market.
Yeah, because we serve, the self-directed retail investor.
Right.
But what we're seeing on the sidelines is, and I think, I think this is one of the reasons the market just continues to go higher. And also one of the reasons you've seen some of these crazy moves in IPOs is there is an appetite right now for speculative risk. We call it like an appetite for asymmetric risk. And people, it's indicative of a fairly, let's say, frothy market. It's indicative of a market that may be rich relative, but there's still this incredible demand. And I think, anytime you get to this kind of, it's also a certain level of capitulation, I guess, to a certain extent. That's what creates that frothiness. But there's demand for speculation, and there's demand for a lot of upside speculation. That's why you see these crazy moves in digital assets. You see these moves in IPOs, and you also see these moves in some of these tech stocks. And I think that until everything reverses and they scare the children a little bit, probably more of the same until they flip the cards.
Okay, now some breaking news. Circle, the stablecoin issuer that has seen a meteoric rise since its IPO in June, reported quarterly results today for the first time since going public. The CEO, Jeremy Allaire, will be speaking here on Yahoo Finance at 11 a.m. And as of now, here's how things look for the digital assets company. Circle said it had a net loss of $482 million, but its revenue rose by more than expected to $658 million, up 53%. And investors are responding positively right now. Its shares up over 8% in pre-market, as you can see. And after its eye-popping IPO, Circle saw shares trading almost 10 times their offering at one point. That just gives us an idea of how optimistic investors are about stablecoin right now. And as the US pushes more favorable regulation and more people around the world use them to handle payments and transfers as well. Now, one more note on Circle. The company now still gets most of its revenues from US treasuries and other instruments, in contrast with other crypto platforms such as Coinbase, which has higher margins thanks to transaction fees. Okay, now before we go, let's have a quick look at the US futures market. And as you can see, it's looking a little bit more negative, but it's pretty stable in just before we get to those important inflation numbers out just before the opening bell. Okay. And that is all we have time for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. And remember, we'll have that interview with the Circle CEO on his first earnings coming up too at 11 a.m. Eastern. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karamali. Go own them.